What happens when nearly double the world's annual silver production trades in a single morning, yet physical vaults are being drained at record speed? You're about to witness the death of the paper silver market. If you thought you understood how commodity markets work, the events of the past 48 hours just rewrote the rulebook. Silver just experienced one of the most violent takedowns in precious metals history, a calculated 22% crash in just 2 hours on the Shanghai Futures Exchange that has left even seasoned traders speechless. But here's what the mainstream media won't tell you. While paper prices were being systematically destroyed, the physical market told a completely different story. What you're witnessing isn't just market volatility. This is a war between two competing realities, between paper contracts and physical metal, between speculation and industrial necessity, and the outcome of this battle will reshape the entire precious metals market as we know it. The violence of what just occurred cannot be overstated. In the span of just 2 hours overnight, silver plummeted from $90 to $73 on the Shanghai Futures Exchange, a 22% free fall that represents one of the most aggressive takedowns in commodity market history. Western spot prices settled at $75, while Western futures landed at $76. But here's the critical detail that reveals the true nature of this event. Shanghai spot remained at $86, and Shanghai futures held at $90. That's a $10 premium that persisted even through the carnage, a price differential that speaks volumes about what's really happening beneath the surface of these markets. This wasn't random volatility or natural market correction. The magnitude and speed of the collapse combined with the regional price divergence points to something far more calculated and systematic than mere market forces at work. While prices were being hammered downward, something extraordinary was happening in the physical vaults that house actual silver. On Tuesday alone, 3 million ounces were removed from COMEX vaults, a single-day withdrawal that hasn't been witnessed in years. Nearly 2 million ounces came out of Asahi, over 900,000 ounces withdrew from HSBC, and another 282,000 ounces left JP Morgan's custody. Additionally, 2.5 million ounces were adjusted into registered status at Loomis, bringing the total COMEX silver inventory down to 400 million ounces. This represents a drainage of physical metal from the system at a rate that fundamentally contradicts what paper prices would suggest about silver's value. When physical metal is fleeing the vaults at this pace, it signals that someone, somewhere, understands that the real value of silver diverges significantly from what futures contracts are pricing it at. The contradiction between paper trading and physical settlement has reached levels that defy historical norms and expose the fragility of the current system. In the first 4 days of February alone, 600 additional silver futures contracts were issued delivery notices, all of them accepted for physical delivery. That represents over 3,500 contracts in just 4 days, translating to 17.5 million ounces of actual metal being demanded. Under normal market conditions, only 1 to 3% of futures contracts settle physically, with the vast majority being cash settled or rolled forward. Right now, we're seeing 100% physical settlement rates. This isn't a statistical anomaly or temporary aberration. This represents a fundamental shift in how market participants are treating silver contracts. You cannot build AI data centers with paper promises. You cannot manufacture advanced weaponry with futures contracts. The industrial and technological demands for silver require actual physical metal, and that demand is now expressing itself through unprecedented delivery requests that are draining available inventory. The attack itself was stunning in its scope and execution, revealing the sheer volume of paper contracts that can be deployed to move prices. On the Shanghai Futures Exchange, 1.44 million contracts traded on the April 2026 silver futures alone during a single morning session. That volume represents 674 million ounces of paper silver in one contract month. Across all contracts trading that morning, the total volume reached 1.34 billion ounces of silver traded in just hours. To put that in perspective, that's almost double the entire annual global silver mine production, traded in one morning. This wasn't retail investors panicking and selling into fear. The pattern, volume, and execution represent a coordinated short-selling attack designed to crash the Chinese silver market and trigger cascading liquidations. Yet despite this massive paper assault, fundamental conditions didn't change. Prices remained at significant premiums versus COMEX and LBMA. Silver remained in backwardation, where near-term contracts trade at higher prices than future-dated contracts, indicating immediate physical demand. The paper games aren't changing the underlying reality whatsoever. The regional price divergence we're witnessing reveals a fractured global market where different geographic regions are experiencing completely different supply and demand dynamics. London spot prices moved into backwardation versus COMEX, with the exchange for physical premium signaling tightness in the London market even as massive leverage unwinding occurred elsewhere. London currently represents the best bid for silver globally, while China and the United States are experiencing aggressive deleveraging. This pattern indicates a broad global deleveraging cycle where futures positions are being violently sold off, while actual physical metal continues to be absorbed by end users and strategic buyers. The metal leaving the United States and China appears to be largely speculative selling, the forced liquidation of over-leveraged positions that couldn't meet margin requirements. Meanwhile, flows into London appear to be driven by genuine physical demand from parties seeking to acquire actual metal. This imbalance between regions explains the current spread behavior and represents stress signals in a system built primarily on leverage rather than physical settlement. The Shanghai Futures Exchange's response to this volatility tells you everything about how seriously authorities are taking the current market stress. New margin requirements for precious metals contracts begin Monday, with daily price limits for silver futures adjusted to plus or minus 20%. Margin requirements for hedging positions increased to 21%, while general speculative positions now require 22% margin. These aren't minor technical adjustments. They represent the exchange tightening controls because the system is under genuine stress. Now consider the implications of potential price floors in this environment. If you're short silver at $70 and a government implements a price floor at $80, you're instantly underwater by $10 per ounce, $50,000 per COMEX contract, not because of market movement, but because of policy intervention. There's no pullback to cover your position, no dip to exit cleanly. Trading below that floor becomes prohibited, your loss is locked in, margins get raised, liquidity disappears, and you face either a devastating margin call or forced liquidation at catastrophic losses. The dichotomy between paper and physical silver has never been more apparent or more consequential for market participants. In just 90 minutes, systematic selling smashed silver prices by over 20%, yet at the exact same time the physical market continued experiencing record drainage and unprecedented delivery demands. Anyone still trading silver through leveraged futures contracts or trusting paper instruments like silver ETFs needs to understand these vehicles are designed to extract wealth from retail participants, not protect them. Forced liquidations consistently transfer real wealth to the same institutional players every single cycle. JP Morgan, State Street, BlackRock, all operating through CME, the entity that owns COMEX. The playbook remains identical, the outcomes remain predictable, and retail traders continue getting crushed while institutions accumulate physical metal at suppressed prices. JP Morgan alone was fined nearly $1 billion for manipulating precious metals markets, paid that fine, and continued the same practices because the profits from manipulation vastly exceed the penalties for getting caught. What we're witnessing represents a historic transition from a paper-driven price discovery mechanism to a physical-driven price discovery system, and that transition is happening in real time with extreme volatility. The invisible hand of free markets has been replaced by visible state action, regional policies, taxation programs, price floors, and direct government intervention. These aren't theoretical scenarios anymore. They're current reality. The COMEX settlement behavior showing 100% physical delivery, the continuous vault drainage, the Shanghai premium persisting despite coordinated attacks, the new margin requirements and price limits, all of these signals point toward a system under stress that's breaking down and reorganizing around physical fundamentals rather than paper leverage. How long this transition takes, how violent the price swings become, and where the ultimate floor settles remains uncertain, but the direction has become undeniable. The strong hands are accumulating physical metal at these suppressed levels, while weak hands get margin called into oblivion, and when the dust settles, the market structure will look fundamentally different than what we've known for decades. The tension between what paper markets are pricing and what physical markets are demanding cannot persist indefinitely. One of these realities will prevail, and all available evidence points toward physical fundamentals ultimately winning this war. The violent deleveraging we just witnessed didn't change the structural deficit in silver supply. It didn't alter the fact that industrial demand continues accelerating while mine production remains constrained. It didn't reverse the unprecedented delivery demands or stop the vault drainage. What it did accomplish was shaking out over-leveraged speculators and creating opportunity for those who understand the difference between paper promises and physical metal. The question isn't whether silver's value will be recognized, but rather how much chaos occurs before the paper system finally capitulates to physical reality. Position yourself accordingly, maintain perspective, and remember that the most violent pullbacks in secular bull markets typically mark the beginning of the next leg up, not the end of the trend. The fundamentals haven't changed, only the price, and that disconnect won't last forever.